शुरू हो गई है. Let's now move on to our this thing. Okay. तो हम चलते हैं अब इसमें. So सबसे पहले what now we have done the projections for this company. Okay. We have found out what is going to be the profit. Okay. And we have prepared the balance sheet, profit loss account, and the projected statements. Now the second job is basically if you are trying to find out the value of this company. Okay. So let's try to find out the value of this company. So सबसे पहले what we do is basically we find out the cost of capital of the company. Okay. Now certain things I've given. Okay. So just we'll find out from where I've got these numbers. I'll just let you know. One is the credit rating of the company. Okay. Suppose the company's credit rating is single A. Okay. Fine. How it has been done, we don't know, but it has been done by some rating agency. So we are assuming that company will be single A rated because the parent company is single A rated. Okay, the company who is doing this business, suppose the rating is the single A. So, which will mean 1.8% over and above the risk-free rate. Whatever is the risk-free rate, suppose the risk-free rate is, for assuming, is 7.5%. Currently, the government GSEC 10-year GSEC is hovering around 7.25 or so. The time when I made this, statement was 7.5. So let's assume it's 7.5 is the risk-free rate, where the government is, taking money from the public or from the financial institutions of the bank. So they are selling their GSECs at 7.5%, and this is the yield of a 10-year bond paper. So that means government can borrow in the market at 7.5%. So your company will be borrowing at 9.3%, which is basically the credit risk premium, which is 1.8%. Okay. If the rating is far better, then the 1.8% will come down. Okay. Fine. So it is 1.8% over and above the risk-free rate. So this is one way of calculating the cost of debt of a company. If the company has just taken a loan, then we can even assume that rate of interest also. Okay. Or if companies' bonds are being traded actively in the market, we can take even the yield of the bond of this company. But unfortunately, the company has not raised any bond, and company has not taken any loan also. Suppose, let's say, okay. So we will use the risk-free rate and add to it the spread 1.8. Now it comes to 9.3%. But for company, the tax rate is 25%. So company's cost of debt after tax will be 6.98. Okay, why we are doing 1 minus T? Anybody? That's a tax shield. So that means the company's cost to the company from their pocket will be only close to about 7%, 6.98. Okay, fine. Is that clear? So now we have done a WACC calculation. Okay, but how we have done, actually, I have just missed out. There is one more point here. Now let's look at, we have to calculate the cost of equity also for this company. Okay. The global beta for office equipment is 1.38. So what we do is basically we search on a Google, okay, and find out what is the beta of companies who are doing similar businesses in the world. Okay, suppose this company is not listed and we cannot calculate the beta. So we must know the beta. So beta, fine, okay. Beta, Damodran. Okay. So there is a valuation expert. It's called, Damodran. He publishes the beta of all the companies in the world. Okay, particularly US companies. Okay, so we have some numbers with us. Okay, so these are the betas. Okay, fine. These are all the companies. Suppose these are all the companies in the world and their corresponding beta of the industry. Okay, this is an average beta of these companies. So just look at the business. Okay, computer services, computer peripherals. How much it is coming? 1.29. Okay, so anybody who is selling computer or computer peripherals, the beta is about 1.29. Okay, so we take this as the point. Okay, fine. So we go back to our sheet and we assume that the beta, global beta at that time was 1.38. So I take it 1.38, not 1.29. Okay, we can take it even 1.29 also. Okay. Now, risk-free rate is, we know, is 7.5%. And risk premium is 16%. How have I calculated 16%? Of course, these are very simple calculations. Okay. So there are all other methods also for doing it. What is the risk premium? What is risk premium according to you? No, what is risk premium? What is the risk, premium? What is RM? RM, first of all. So this is basically the market rate, market return. So how do we calculate the market return? So let's take Sensex. Fine. Sensex was 100. Okay. Okay. Let me just take it. We can take any point of view. We are taking right from the historic returns of Sensex. So Sensex was 100 in 1978. Okay. And what is the Sensex today? Just check. Sensex. So 2022. Okay. It is how much? Just check the Sensex. How much it is? Huh? 62,500 I'm just taking, okay? Number, rounded off number. Okay? Fine. So how many years have gone by? 44 years. Fine. In 44 years, 100 rupees has become 62,500 if you have invested into equity market. If suppose you had put 100 rupees in all the Sensex companies, or you have bought a mutual fund representing Sensex, okay. So there was a index fund which is representing Nifty or Sensex or anything, so you can buy also that. Suppose you have bought in 1978, suppose there was a mutual fund representing Sensex. So Sensex was 100. So your money would have grown to 62,500 in 44 years. So what do? We just go to formulas and look for rate formula. So to look at, what is the kind of return the Sensex is given. This is 44. Okay. And present value was minus 100. This one. And the future value which has become is 62,500. Okay. And just enter it. It comes to around 16%. 15 point something, eh? But rounded out number is 16. So that means Sensex over the last 44 years has given you a return of how much? Close to about 16% per annum. Now, if suppose you have put this 100 rupees in a fixed deposit, okay, fine. And how much return you get on a fixed deposit? नहीं, फिर भी on an average कितना होगा? 44 years में कितना ले सकते हैं ballpark? 6% चलो. It is sometimes 6%, sometimes 7%, sometimes 8%, sometimes 5%, depending upon rate of interest prevailing by the bank. So at 6%, what is the number you will be getting here? Aapka, if you suppose put 100 rupees at 6% for 44 years, how much money you would be getting? So recently we calculated the future value, is it? Fine. The rate is how much? 6%. And present value is, the is how much? 100. Okay. And NPR is 44. So 44 years you have put the money. Suppose you give me 100 rupees today, and I give you after 44 years at 6% rate of interest. It would look like this. Is that okay? So how much money will be getting? Only 1,298 bucks. Look at the amount of the Sensex, the return which the Sensex has given you. If you would have invested in a fixed deposit at 6% for the same length of period, okay, your 100 rupees would have grown to only 1,298, and in a Sensex it has grown to 62,500. So now what is emerging? That if this is called magic of compounding, if you're earning at a much higher rate, then the amount is going to grow up so much that it is going to give you a dramatic return as compared to if you park your money in a fixed deposit. Now, which is more riskier in a long-term horizon, the fixed deposit or a Sensex? No, but in a long term, it has given you 16%. On long-term basis, the markets are more rewarding. The fixed deposit is risky because if suppose the inflation was around 6%, okay, अगर आपने पैसा अगर suppose you thought the Sensex was risky, then you would have invested in a fixed deposit. Your money would have grown to only 1300, and Savia's money was put in a Sensex would have grown to 62,500. So if you put the money for a long period of time, okay, then you're going to get rewarded. So Sensex is not risky for a long period of time. And we have seen so many things. We have seen COVID. We have seen, so many things, so many scandals happening in the stock market. Arshad Mehta scam, Ketan Parekh scam, then, the financial meltdown which happened in 2008. Despite all those things, the markets have risen. Okay, fine. And it has given a return close to about 16% as compared to a 6% return which your fixed deposits have given you. So your money has grown only by 1300 rupees. Fine. So now tell me, is the market safe or the fixed deposit safe? Markets are safe. So you have to change your, thinking. Okay, now why people say the markets are riskier? Because of two reasons. One, if you have a time horizon of just 1 year or 2 years, the markets can be risky. Fine. अगर आपको पैसा सिर्फ 1-2 साल के लिए लगना है, 6 महीने के लिए लगना है, put them in a fixed deposit. Don't, invest into a Sensex. Sensex is not going to can give you even a negative return. Okay. Like for example, last year, till date, the Sensex has given a very small positive or even negative return. Okay. Maybe just 1% return the market is given in 1 year's time. We can check that. Okay. Sensex today. Okay. So the market has given, let's see, 1 year. Market has given what? 7.54%. अब जो market बढ़ गई है ना, it's giving you 7.5%. It's not giving you this thing. 5 years time. 87, it is a cumulative. Okay, it's a cumulative. So 87 is in the 5 years. So you divide by 5 to calculate the number. And maximum, it's showing the maximum period about all time. All time is about 26. Okay, fine. Just divide this number by 44 years. Suppose it is starting right from 1980s when the Sensex was started. So 26,477. It has gone up by 44. I mean, how much time? 44 से divide करो कितना आता है? Huh? So maybe that's some wrong. So anyway, so this is your, the return which the Sensex is given is far better. Okay, compared to a fixed deposit. Fine. So is that okay? Have you got the message? But if you are investing for a short period of time, then it makes sense to put your money in a fixed deposit because it may not be able to beat. Even in the last 1 year, it has beaten the fixed deposit because the fixed deposit would have given you 6%, the market has given you 7%. But here is the market as a whole. Maybe you are invested in some bad stocks, it might have given you a negative return also. Okay? Or invested in some good stocks, it would have gone because that's an average return. So if you have a short time frame, then markets are risky, definitely. So you should not, if you have money for only 1 year, don't put the money in a stock market. At least you should have 3 years time horizon. Okay, fine. Number one, markets are volatile. Okay, the markets have given you 16% return. It's come with a lot of volatility because it has a high standard deviation, close to about 20%, for example. So it keeps going up and down, keeps going up and down. Okay, so you don't like, that kind of volatility. So that's why, you want to be putting your money, which is giving you, without any volatility, return of about close to about 6%. You are happy with that, but you should not be. Volatility is part of your return. If you have a long time horizon, 5 years, 10 years, okay, you should be putting your money in markets. Even the last 5 years, the market has given you around 12 to 13% return. If you go back and, reframe our numbers and make it, what was the Sensex at 5 years back, and then try to calculate, it has given about 12 to 13% return. Okay, I can show you that. Let's see. Let's go to, another site called Value Research. Let's see some, like Nippon, कोई भी हम वो रख लेते हैं. Nippon India Growth Fund, okay, fine. So let's, because that's an equity related fund, okay, fine. And just go see, how much return it has given you in 3 years time? And let's say, okay, so let's see, because we wanted to know the return of the Sensex, okay. So, कहीं पर returns आ रहा है? Returns detail, okay. It will compare with the benchmark also. Okay, look at this. Fine, it is not giving the Sensex, but it's telling you because the benchmark is S&P 500, 150 mid cap. So basically, mid cap is, we have taken actually a mid cap fund, okay. So in the 7 years, what is the kind of return the mid cap index is giving you? 16.92% in the 7 years. Okay, this fund has given you 17%. Look at the 5-year return, 13%. Okay, look at the 1-year return. The mid cap has given you only 4%, whereas this fund has given you 9%. So as your time horizon shortens, there is a lot of volatility. Return chances are that you may not get that return. Like in 1 year, the return is not that much, but it is still beating. This fund is beating the fixed deposit return, but it is the overall index is not beating the returns offered by a fixed deposit. But if you look 7 years down the line, this fund is giving you a good return. We can take even large cap and see. Anji? 6 months, the market has turned around, basically. What has happened in the last 6 months, the market has actually bounced from a lows. Okay, there was a Ukraine war and so many other things happened, COVID. So after, everything settled down, war is still going on, but it is not producing that much of problems for the world. So the market has bounced back in the last 6 months. So the last 6 months, it has given you 21%. In a short time frame, there can be a lot of volatility. But 6 months prior to this was a negative return. अगर हम 6 महीने पहले बैठे होते हम देखते पिछले 6 महीने की रिटर्न और नेगेटिव रिटर्न. Why? Because the 1 year return is only 9%. So that means all the return has come in the last 6 months, isn't it? That means the 6 months prior to this was a negative return. Okay. So there's a lot of volatility in the returns offered by the markets. So that's why the markets are not considered a very safe kind of a place where if you are a very short term time frame. If you have got 6 months time with you only, Savia, where you are going to invest? Into the market or into fixed deposit? But if you have got 6 years in time frame with you, market. So markets are not risky. As we have seen, the markets has passed through so many phases of, we have seen 2007 financial meltdown. We have seen COVID. In 1930s, there was again a great depression. Okay. So, which has happened. Okay. So all those things have happened. So many scandals have happened. The market is still giving you around close to about 16% return, which is a good thing. Fine. So, let's close this. So this is basically, so what our purpose was to calculate. Now beta we have done. The market return is how much? 16%. Average return given by the market is 16%. So this 16% comes from there. Is that okay? So how much it has given more than the risk-free rate? 8.5%. So 8.5% आपने ज़्यादा कमाया है. Had you parked your money in a government security, 10-year security, you would have got only 7.5. Now you're getting 16 in putting your return in a market. So you're getting 8.5% risk premium. Okay. Since your stock is more volatile than the average market, so which means the beta multiplied by the market return will go up to 11.7%. Higher the beta, the chances that you are going to get higher return. Okay. This stock ka beta zyada hota hai. In good times it will reward you, in bad times it will punish you. So here, if you take the upper side, it is 11.7% will be this thing. Add to it the risk-free rate. So that means cost of equity is 19%. So this company's cost of equity is 19% through using a CAPM model, which was given by one of the experts. Okay, of course, not a very foolproof method because it has a lot of lacunas also. Okay, because the one other thing which I can tell you straight away is the beta itself. Okay, beta is 1.38. Fine. Now, beta captures what? The market risk, isn't it? Now, there is one number which is capturing all the kinds of market risk which is there in the world. It's very unfair that only one figure should be able to be assigned to calculate the risk of everything. Now, risk can come from many sides. Okay, the interest rates going up, the petrol prices going up, monsoon failing. So, all the things have been clubbed into a very simple calculation beta. So it's become, the formula is very simplistic. So there was another, mechanism. There was another, thing which is called the another methods which have come basically, which have not actually gone so far. Okay. So there are two more models which tell you how to calculate the same thing. So we are not doing that. We'll keep it for some other discussion. Multi-factor model. Okay. So there's another model where we have the beta for each kind of market risk, whether it is interest rate risk or whether it is the any other risk which can be classified into macro factor. So we make betas for all those risks and then do again calculate the cost of equity of company, which is a more complicated formula. Okay, and you can make a lot of mistakes while doing it. So this remains the default model. The CAPM model made by William, who was that? William Sharp remains today the most acceptable model. Though of course it's a very too simplistic model to compute a beta for company and for a cost of equity of company. Okay, and the beta itself can change. Whether if you take a weekly return or monthly return or a yearly return or whatever period you return or any index you take, the beta can change. So it's a statistical driven number which can change if you change the parameters of calculating the beta. So इसलिए बीटा भी काफी जो है, अगर आप 6 महीने का बीटा देखो, पिछले साल का बीटा देखो तो फर्क आ जाएगा उसी कंपनी का. If you historically regress the returns of the stock versus the market, you get the beta. Now she may be doing last 6 months return and calculating the beta. I may be taking last 1 year return and regressing the return. I may get some beta. So both betas will be different. Okay, she is taking Sensex. I am taking Nifty. Again, the betas will be different. So betas can differ depending upon what kind of benchmark you have taken, what period you have taken, whether you're taking daily returns, monthly returns, weekly returns, or 6 monthly returns. So everybody takes different returns for calculating the beta. So betas can differ. So there is another approach for calculating beta, which is called the bottom-up approach. We'll discuss sometime later. Okay. So इसका cost of equity कितना आ गया? 19%. So now what we do is basically, now we know that the company has taken, company's 1 crore is equity and 5 crore debt है. So company की WACC आ जाएगी 9.02%. Look at it. Okay. Fine. So 17% is equity, 83% is debt. So multiplying these two numbers, okay, the cost of debt and cash cost of equity, we have calculated the WACC, which is 9%. So 9% cost of capital of the company. Is that okay? Yes, sir. Fine. So I'm just going to, okay. So let's start with this. So I'll start here only. Year 1. So yeah, I've just copied the EBIT of all the years. Year 1, year 2, year 3, year 4, year 5. Is that okay? Yes. Fine. So ये आपका EBIT आ गया. EBIT 1 minus T. Okay, the formula EBIT 1 minus T. Then first year there is no tax, so it remains the same. Rest year, the tax is going to reduce the EBIT. Then depreciation add, capex add. So we have the free cash flow increase in working capital. Okay, year by year I've calculated. So I have got the free cash flows of the company. Okay, ये सब free cash flows आ गए. Is that okay? Now the last is called the terminal value, which I'm going to explain little later. First, look at this. So this is the present value. What I'm doing, I'm discounting all these cash flows using the cost of equity, cost of debt, sorry, cost of weighted average cost of capital, which is 9%. Look at the formula, how it has done. Present value 9%. Okay. So here the value is key, this money you are getting in the after 1 year. So the loss you are making is after 1 year. So this will be present value is 4 lakh 30. But today's value loss is 430. This today value is 83 lakhs. Today's value is 1 crore 10 lakhs. Similarly, I have calculated for all the 5 years. Is that okay? वो 3 years है, years है. Okay. 3 साल है ना, ये वैल्यू जो है 1 करोड़ 42 लाख की हम प्रेजेंट वैल्यू निकाल रहे हैं. ये तो 3 साल के बाद आपको मिल रहा है, तो आज की वैल्यू कितनी होगी? We'll do that. Okay, is that okay? Have you got it? And this you will get 4. Fine. यहाँ पर आपको 4 दिखाई देगा. ये देखो इधर. Just look at it. It's 4 here. So present value at 9% for the column I18, I8, 4 years. Okay, fine. Is that okay? Is that okay? Now year 5 also the same thing. Is that okay? Then because the company is going to do business forever, it's not going to stop about 5 years, isn't it? So company is going to earn free cash flows even after 5 years. But we are saying these 5 years were the greatest years of the company. Company was growing. But thereafter, company is going to grow at a stable growth rate. We are assuming the first 5 years, or we can assume even the first 10 years, but here I am assuming the first 5 years will be explosive growth, and thereafter there will be a stable growth. If it is going to be a stable growth, I can assume that percentage. What I have assumed, 4%. It is here. What we do, we take the cash flow of the last year, okay, which is this K8, ये figure ले ली हमने, ठीक है, okay, is that okay? Into 1.04, 4% के हिसाब से बढ़ रहा है every year, divided by the cost of capital, WACC 9%, minus the growth. The formula here is basically terminal value का formula क्या होता है? It is something called terminal value, TV, which is basically the cash flow 1 plus growth, okay, and WACC minus growth. So this is called the terminal value. Suppose if I go on, my cash flow is going to grow at a certain percentage. Right? If I assume the company is going to grow at 4%, okay. So if I do calculate the total terminal value of the company, अगर company के बाद, अगर कभी रिटर्न अगर आने होती है, पहले 5 साल की तो हमने सबकी अलग निकाली, उसके बाद एक पैटर्न बन जाएगा. Please listen to me. There will be a pattern only. The growth, the cash flow will happen at 4%. Okay? The cash flow will keep growing at 4%. So there is a small available formula which you can calculate what will be my total value till infinity. Because the company is going to last forever, usually. So the company's cash flow will keep growing at this growth rate. Divided by WACC minus G, it will give you a terminal value. So I got a terminal value now. Okay. इसको और थोड़ा expand करेंगे later on what is terminal value. So this comes to 51 lakhs 66,000 1,600 something. ये value आ गई. Okay. Now what I am doing is I just add everything up. Okay. इसकी भी हमने present value निकाल ली. इसकी present value इतनी आ गई. Using the same formula at 9%, I've calculated the present value. So I just added up all. So the total value of the firm is coming this much. Okay, fine. Which I have put here. Value of the firm. यहाँ मैं बैठा. ये total cash flow grow कर रहे हैं उसकी present value में. जैसे I gave an example, you have an asset. You have a property which is giving you a lakh rupees rent per annum, which is growing at say 5 or 10% per annum every year. Okay, so what will the value would like to have today if suppose you want to sell that property? It is the present value of all the cash flows which you are going to get. Okay, so this is the present value of all the cash flows the company is going to generate. How much? 341359,275. Okay, now if I reduce the borrowings out of it, this will become the value of equity shareholders. And if we divide by the number of shares the company has, 1 lakh shares, 1 crore shares, if the face value is 10 rupees, so there will be 10 lakh shares. So value per share comes to 291. So that means this company's value today, the real value of the share of this company should be 291 rupees. Is that okay? अगर ये मार्केट में 200 का बिक रहा है तो खरीद लो. That means it's undervalued. हाँ वो क्यों लिया हमने ग्रोथ को 4% क्यों लिया है दैट्स अ वेरी गुड क्वेश्चन ओके ये अच्छा क्वेश्चन है प्लीज क्वेश्चन मी ओके दैट्स वेरी इंपॉर्टेंट नो वी हैव टेकन 4% नो नॉर्मली हाउ द एनालिस्ट टेक दिस परसेंटेज दे टेक इट 3% 4% 5% okay what is the logic behind we see what will be the India's growth rate long term growth rate of India okay because if the government the whole industry is going to grow at say 5% GDP fine that's an average like if you look at US they are growing at 3% or 2% as the countries become more mature the growth rate falls okay because the companies have become very big so the percentage increase is not going to be so much like 10% 20% whatever having in India we are growing at say 7% but it is going to taper down to about 4 to 5%. So the companies which are there in India will go on an average around 4 to 5%. Fine. So this 4% comes from that logic that either it has to outperform India's growth rate, okay, or it will fall in the growth rate but the India's GDP is going to grow. So we take only 4% as a safer side. Because if we increase this percentage, my share price is going to jump. Suppose I make a change here and I make it say 5. Suppose you say that 4% is too low because this company is good, the share price will go to 379. Again, because what people do is people change this parameter if they want to make the company look very good.
So अगर हम इसको इंडिया में इक्वल ले लें या फिर एक या दो परसेंटेज कम ले लें तो वो रैशनल होगा मतलब
हाँ वो रैशनल होगा तो जितना कम लोगे तो दैट मीन्स देयर इज अ कंजर्वेटिव वे ऑफ valuing a company. There is more, you can be more optimistic of the company. So you can paint 2 or 3 scenarios. Optimistically the company may grow at 5%. Pessimistically the company may grow at 3%. Somewhere the base case will grow at 4%. So this is the base case which we have studied. Okay. तो हमने base case सीधा बना लिया 4. तो उसमें आ गई 279.
इस तरह से मतलब हम किसी भी कंपनी का वो निकाल सकते हैं जो मार्केट में अगर हमारे
एब्सोल्युटली नो. हाँ आप सोचते इसका पर्पस क्या है? वेरी इंपॉर्टेंट बिफोर वी एंड. This is called the DCF technique through which we calculate and we use a terminal valuation formula. So you go and study this. जब भी time मिले, you study the terminal value formula and you will understand what is this formula. Okay, that is homework for you. Now, when we do these calculations, number one, even for the companies like Reliance or any company which is traded in the market, we try to do these calculations and see what is the fair value. Now, sometimes people say Reliance is worth 3,000. It's today trading at 2,800, 2,700. Go and buy it. It is trading at a lower value than its real value. So how the analysts say that the share should be bought? They do this DCF technique and calculate the value of the company. But analysts can differ. Okay, because you can make so many assumptions because it involves a lot of assumptions, a lot of calculations. So if 2 people are doing, they can come up with different numbers. So that's why what we do is if there are suppose 30 or 40 analysts, we take the mean of them. Suppose somebody says that Reliance will go to 3,500. Somebody is saying 2,600. Somebody is saying 3,000. So we say average is close to about 3,000. Okay, fine. So that's an average recommendation of all the analysts, whether it's Morgan Stanley, whether it's any company or the ICICI Capital Securities or whatever. So what we do is we just take the average. Kahin na kahin average, cleans all the number. Average is a great, purifier of the number because the average, some people may be very optimistic, some may be very pessimistic, some may be somewhere middle. So you should take a middle path. Fine. Middle is always better. So ये middle path है. Is that okay? हाँ. अब ये जो हम क्यों करते हैं? Analysts do it for all the companies, whoever is listed. Then the companies which are not listed on the stock exchange. Like, I told you that, we were involved into, selling a company when I was in Hero Motors. So we did this technique and calculated the value of a company. Fine. And said this is our value. We have done all the projections of the company. अच्छा एक तरीका और होता है that is based on the PE valuation. P ratio. Companies trading at a certain PE multiple. तो लोग उसको भी यूज करते हैं. That's called relative valuation. But that is not a very foolproof method of valuing the company. Why so? अब मुझे बताओ क्यों what is the defect in PE valuation or any valuation metric, whether EV to EBITDA or any method, उनसे वो उतने ज्यादा साइंटिफिक नहीं है जितना ये मेथड है.
रेशियो में हमारे पास जो मतलब फॉर्मूला की प्राइस से डिवाइडेड बाय अर्निंग पर शेयर से मैं मैनिपुलेट कर सकता हूं.
No, just listen to me. Okay, what you are saying is right. If you just keep applying your mind, you will get the answer. The answer is for calculating any multiple, we are using the market price of the share divided by a numerator. Okay, so there is a numerator and denominator. So numerator we are always taking the current price, isn't it? अब जो current price है, हो सकता है कि वो, I mean that is, there is a lot of froth in that price. The markets can be either optimistically overvalued or can be undervalued at any given time. So market make mistakes. So markets are never fairly valued. Kabhi people always think that the companies will do very well, the growth rate will be very good. People keep buying, and pushing up the prices. Sometimes the people are very pessimistic. The war is there, COVID is there. They pull down the market by 30%. So we have seen in 1 year there was an extreme. Market was 30% down from its top. So if you look at 30% upar, 30% niche. So which is the right value? You don't know. Isn't it? The markets cannot give you the right value. Market is guided by the current situation prevailing in the the scenario. It's a COVID time. We don't have the vaccine, and we thought that there'll be a big problem in the world. Most of the people will die. So why to hold investment? So people were pulling down the stock markets. They're bringing down the stock. The same thing happened in the financial meltdown in 2008. The stock, all the stocks came down, crashing down by 60%. The Sensex, which touched 22,000, became close to about 8,000. 22,000 सेंसेक्स से सिर्फ 8,000 आ गया था. So not only which was the right value, 8,000 or 22,000, nobody knows. So if you are trying to value a company when the Sensex is 8,000, and if you're trying to value a company which is when the Sensex is 22,000, you get two different values using the P multiples. But DCF technique will give you. DCF is not bothered about this at all. How the markets are looking at the stock. So it is basically based on how much the profit the company is going to generate, what is the cash the company is going to generate. But since it involves so many things, okay, finding out the beta of the company, finding out the risk-free rate, finding out how the projections are going to be done, at what rate the sales will grow, at what rate the profit will grow. So there are so many calculations. Okay, it's not a very easy thing. You have to assume a lot of things, and people can suppose if I sit with a CEO of the company, and he wants I just say how the company is doing. He said do very well, because he can't say the company is not going to do well. He says the company sales will go up by 20% every year. So if I build all that, I'll get a very good value. If suppose there is another person who is very pessimistic about the company, is not related to the company, he will say no, the sales will go by only 5%. So value will be different. So even the DCF method can give you different kind of valuation of the same company. It will all depend who is valuing, who is giving you all this thing, the various assumptions. Fine. And then there are so many mechanisms through which we can calculate the risk-free rate. Okay, not only the risk-free rate, what you have chosen 7.5, we can calculate differently, which I can teach you next time. कई तरह के mechanisms हैं. So if any assumption changes, it like growth rate changes, things can change. अगर मैं 4 से 5% growth ले लेता हूँ, the stock price jumps to about 390, isn't it? So this method is also not far from defects. Fine. These are all art, this is not science. So basically, this is, so you do calculation basis of everything. Okay. Use the relative valuation, use the DCF technique, but relative technique remains the most powerful and the best technique of valuing companies. Is that okay? Any questions? I'm just stopping the recording now.